These presentations will work a comprehensive bookkeeping problem both within Excel as well as within QuickBooks. Excel having the advantages of being able to see all the components and how all those components fit together to make the end product, that end product, the financial statements. QuickBooks having the advantage of being able to use forms, simple data input, and an automated system in order to convert that simple data input into the end product, the financial statements. We will work each component of the problem in Excel first and then work that same information in QuickBooks. Hello, in this presentation, we will record a deposit related to a short-term investment becoming due into our bookkeeping problem in Excel, keeping in mind how that same information might be input into accounting software such as QuickBooks. If you would like more information about the QuickBooks Pro, take a look at our comprehensive course in the link below. We're going to first take a look at QuickBooks and see how this might be affecting QuickBooks first, and then jump into Excel and put this information into Excel. What we're saying here is that we have a short-term investment, an asset account. We can think of it as a savings account or a CD account, some short-term investment that has then become due and is now being deposited into our checking account with both the original investment and the earnings on it, the interest on it included. If we were going to enter that information into QuickBooks, then note this is also, by the way, something that we might find when we do the bank reconciliation. It's often a book problem when we do bank reconciliations that we find this deposit in our checking account and we didn't have it recorded in our books. How did it get there? Well, it might be that we had a CD with the bank or some type of investment with the bank that had matured, and then they automatically deposited it into our checking account, and we would have to then record it. We're going to say here that we have that in our checking account. We know that it went into our checking account, and we need to record the fact that our checking account went up. The asset account that we had before, the investment in the savings account or the CD account, is going to go down, and we are going to earn some interest on that. So there's a couple ways we can do this into a system such as QuickBooks. We can enter a journal entry, or we could go to the register. We can go to a couple different registers. I would always go to the check register if the cash is affected. That's the easiest one to think about, easiest one to know about, the one we've probably thought about most. So one way to enter this transaction into a QuickBooks system is to go to the check register and record this deposit. As we record this deposit, we would put the credit, not the credit, well, it would be a deposit in our check register rather than a payment. We're on the deposit side of whatever the deposit is, in this case, $12,250. And then we couldn't just record the other side to some other account. In this case, the investment account, an asset, something that's on the books that we need to reduce. This is the original investment that we put into some type of investment at the beginning, the original cash investment we put into a savings account or a CD account, and now it's becoming due. So we're getting it back, the $12,000, but we got more than that. Why? Because we also got interest. So if we were to record this into the check register, we'd have to use the split icon here and record both the principal and interest amount. We'll now record this entry into our bookkeeping problem in Excel. One of the nice things about recording when we record in Excel is that we can see what account we're dealing with. We know, one, that we're saying that the checking account went up. We're basically saying, hey, we saw our checking account go up. There's a deposit in our checking account when we went to the bank of $12,250. So that clearly happened. We can also see the other side because we're looking at the trial balance here. And the other side, we're going to say, well, why did that happen? Because, as we said, we had a short-term investment or a CD or some type of asset account, some type of investment. That should be on the books, and we can see it here. So there it is. There's the $12,000 original investment. That $12,000 then represents the original money that we put into the investment, does not include the interest that we earned on the investment, which we would then receive at the point in time the investment became due and got deposited into our checking account. The difference then will be the interest revenue that we have. So we're going to go ahead and record this. We're going to say that this happened on February 6th. So on A13, we'll put 2/6. We're going to say that the checking account, is the checking account affected? We're going to say yes, because we got a deposit for this becoming due. That's really how we would kind of know that this happened. We check our bank account and say, hey, there's a deposit there. How did that happen? Well, because this investment became due and it automatically deposited it into our checking account as we told the bank to do once it becomes due. So we're going to say that's going to be deposit. It's going to go up. We're going to do the same thing to it, which is a debit. So we're going to copy that account. We'll put it down here in B13, right click and paste 123. The amount of the deposit then would be given to us, and we would know that it was $12,250. We see that in our bank account. Then we're going to credit something. Where did that come from? Well, we're going to look in our balance sheet and say, well, I doubt the bank made an error. We probably got that somewhere. And it's this item here. It looks like it's that item. It's pretty close. It's a little different, but it looks like it's that short-term investment. A little research will tell us, yes, that short-term investment became due. And now we no longer have that. That was deposited into our checking account. Therefore, this needs to go away. It's a debit of $12,000. It needs to go to zero. We're going to do the opposite thing to it, therefore, which is a credit of $12,000 to the short-term investments. So we will copy short-term investments, put that in cell B14, right-click and paste 123. We're then going to go to cell D14 and put credit or negative 12,000, and there we have it. Now, of course, we have a difference. 12,250 minus 12,000 means we need another credit of the 250, and we're going to do that with the plug formula, so I'm going to put the negative sum of these cells. I'm going to say negative SUM, double-click the sum function, and then highlight those cells, and it'll take the difference, giving us a credit of 250. Where is that going to go then? What account do we need here? That will be interest income, interest revenue. Scrolling down, we see the interest income down here. So there is interest income. It is an income account, but we put it into other income because it's not part of normal operations. That's why it's on the bottom, not in the normal revenue accounts. So we're going to copy that, right click and copy. Then scroll back up, and we're going to put that here in B15, right click and paste 123. There's going to be our journal entry. We're going to highlight this, going to go to the home tab, going to go to the alignment and increase the indenting. So we have journalized the journal entry here. We will then post the journal entry to the general ledger, then using that to create the trial balance and that to create the financial statements. So note these transactions we're working with here are a little bit more tricky than the ones we've seen so far, or most of them, because they do require one other account here to make these transactions. When we're dealing with interest, whether it be interest expense or interest income, they can make the transaction a little bit more tricky, and it's important for us to understand what that interest income is doing to the net income down here, to the calculation on the income statement. So let's record this. In order to do that, we're going to freeze the panes first. Put our cursor in AJ1. We're going to go to the View tab, Windows Group, Freeze Panes, and freeze the panes. Freeze the pane. That makes it hurt less. Then we're going to go to the checking account here. That's going to be the first account. Here is the checking account there. And we're going to be down here in AM10. So we'll be in AM10, the checking account, and say equals, and point to that 12,250, which will bring that 91,719 balance up by 12,250 to 103,969. Then we're going to have this second transaction here. This is the short-term investment. That's going to be this asset account right there. It's going to be, what is that, the fifth, 1, 2, 3, 4, 5, fifth account. It's going to be the fifth account to the right on the general ledger as well. We're looking for the short-term investment. There it is. I'm just going to make it go right next to it. So we want to be here in the credit side in cell AV15. We are in cell AV15 equals. Point to that 12,000. That will bring this balance down by 12,000 to 0. Then we're going to go back. We, of course, will see that 0 back here on the trial balance right there. And then we have the interest income. That's going to be way at the bottom. So it's way at the bottom, interest income. It's going to be the last account then on the general ledger as well. So we're going to go all the way, just holding down the right arrow, going all the way to the right till we see that last dark blue account, scrolling down to the bottom till we see that last dark blue account. We want to be in the credit side because it is income. Scrolling back up, we're probably not going to get it on the same screen, so I'm going to be down here. I'm in BT38, cell BT38. I'm going to say enter, scroll up just a bit to find what I want to put there, so equals, scrolling up just a bit, we want that to 250, and enter. So there it is. If we click on it, you could just type in D15 or equals D15. There's the 250. Now we're going to scroll all the way back. I'm just going to scroll all the way back to the trial balance. There's the 250. What did that do to net income? It brings net income up, or in this case, makes the loss less. Note we have interest expense, interest income. The expense is greater than the income, so we have a loss, meaning the debits are greater than the credits at this time. So that's what we have there. That's going to be this transaction. We're back in balance. Let's see what happens to the financial statements. We did something to the checking account. So I'm just going to say, what did that do to the financials? We did something to the short term, and we did something to the interest. So let's go see the financials. Remember, the financials are being automatically generated. Scrolling to the right till we get to the financials. And there we have it. The cash has been adjusted. The short-term investment goes to 0. If we go to accounting software, that typically means it'll just go away on the reports, but we're going to show it here. And then we have the same assets equal liabilities plus equity still, which is good. Then going down to the income statement, we see that we have a credit or a income in the other income of 250. By the way, this interest expense might be better placed down here as well, but I don't believe it was in the data system we were looking at, so it's up there, but it might be better placed in other income as well. In any case, this is a form of revenue, and this is going to be an expense, and therefore we have a loss of the 346. That 346 is also down here in the statement of owner's equity, part of the calculation for ending owner's equity of 143,828.29. And we also see that, of course, on the balance sheet here, all the statements tying together, all the statements being created automatically, as can be done in QuickBooks, but now we get a picture of what QuickBooks is doing or what accounting software is doing so that we can troubleshoot problems. Hello, in this presentation we will record short-term investment deposit in QuickBooks Pro 2018. In other words, we have an investment that has become due, and therefore we're transferring it out of the investment asset account and into the checking account. If you have been working along with us, we will be continuing along with the Get Great Guitars. If not, that is okay. We will be recording this transaction, transferring an asset that has become due in terms of a short-term investment from the asset to the checking account. We currently have the home page open, which you can find at Company and Home Page. If you have the backup file, you can restore that backup file to this point at the file and restore the backup file. It's good to have the same point in time. The backup file will provide that, or if you've been working through the problem, to be at a similar point in time so that we can start here and move forward. However, if you don't have access to that, or if you're looking at a different file, that's okay. We can go through this setup and get the most out of this setup. Note that we do have the open windows not open over here. We're going to select open windows by selecting the view page and open window list. Now we have the open window list only being the home page at this time. Our goal here, the objective, is to convert a short-term investment that has become due, and now we are receiving the deposit from that. So we're going to scroll over and take a look at where that short-term investment is, and then record the expiration of that short-term investment, decreasing the asset and putting it on the books in cash as the cash has been received for it in the checking account. To do that, we will take a look at the balance sheet. So we're going to go to Reports up top. We're going to scroll down. We're going to go to Company and Financial. Then we're going to scroll down to the balance sheet. We're going to change the date range up top, so when we drill down on the data, it will have a range. So we're going to customize, and the date range is going to be 01/01/21. We are working in 2021, starting with January 1st, 2021 to 12/31/21. There's our date range. We're going to say OK. Looking at our balance sheet, we see the short-term investment right here at the $12,000. What we're going to say is that short-term investment has become due and we've received that $12,000 plus interest of another $250. $12,000 plus the $250 then is what we are going to need to record in terms of a bank deposit, and we're going to have to into our checking account, and we're going to have to reduce this amount to 0, it having been expired at this point, and we're going to have to do something with the difference. That will be interest revenue, some form of interest income, interest revenue. A couple ways we could do this. We could go to the short-term investment register and record that transaction there. We could go to the journal entries. We could record this as a journal entry by going to the company up top and make journal entry. If we were to do it that way, we would debit the checking account. We would, for the amount that was deposited, $12,250, credit the short-term investment, and then credit the $250 to the interest revenue. However, it might be the easiest thing to do would be to go into the check register and record this as a deposit directly into the check register and use the check register to split those accounts, and thereby not really needing to know debits and credits as we record this. So let's take a look at that option. We're going to go to the banking drop down. We're going to the use register, and we're going to keep the check register as the register we will be using and say OK. The date of this transaction is going to be 02/06/21. So to February 6, 2021, the check is not going to be correct. We do not want a check there. What we want is a deposit. I'm going to show that by just typing in DEP just to eliminate the check number, so when we write another check within this field, the correct check number will pop up. And we don't have a check now, but this is just going to be an implication that this is going to be a deposit entered directly into the check register. Next, we're going to say Chase is the investment that we had in. That's going to be our bank. We're going to say that this investment was with Chase, like a CD or a short-term investment. We're going to say tab, and we want to make sure that we are in the deposit screen, not the check screen. We're increasing. This is the deposit side, not the payment side. And we're going to enter the $12,250 there and tab. Now we need an account. Now we only have the one account here again. We need two accounts in order to record this. One, we need to record the decrease of the $12,000 investment originally, and we need to record the $250 of interest revenue. So in order to do that, we're going to select the split item here. That'll give us our accounts that we can select. One's going to be the short-term investment. That needs to go down to 0, but only for the $12,000. The difference then needs to be going to some type of interest revenue. So we don't have interest income, it looks like, from the accounts that were set up originally when we set up these accounts through QuickBooks. QuickBooks generated this chart of accounts using the merchandising setup. We could put it into uncategorized, but it might be more specific for us to put it into an account called interest expense. So we're going to say interest revenue, or interest income, I should say, income. I'm going to type in interest income. It's going to be a new account. So when we select tab, it's going to say we don't have this set up. Tab. Interest income is not in the account list. We're going to go ahead and set that up then. Setting up the new account. Now it's going to default to expense when we enter something into the check register, and that's not what we want. We want it to be income. So we're going to say drop down, and we're going to look for income account. And we want it in other current income to be more specific. It's not our normal income operations. We don't typically get most of our income from interest. And therefore we're going to put it into the other income selection. Everything else will remain the same, and we're going to say save and close. There we have the item. So the $12,250, that's going to be the increase to the checking account. The two other accounts affected, decreasing the short-term investment, decreasing the interest income. Let's go ahead and record that and then take a look at the impact on the financial statements. Going back over here to the balance sheet, we're going to select the balance sheet and see if it does what we would think it to do. We should have a increase in the checking account for the amount. So we're going to double click on the checking account, and we have an increase in the checking account for, here it is, it's not quite at the bottom because we entered that last one a little bit out of order in the date range. So we have the 26 here, it's the 12,250 that we increased in the checking account. If we double click on that, it goes to a deposit screen. Note that we entered it directly into the check register, but when QuickBooks looks at a deposit, this is the driving form. So it's going to go to the deposit screen there. We can close that out. Just to verify that it is the same transaction, we can look at the check register in the open Windows items, and we can see that we do have that amount here as well. If we were to double click on this little DEP, we would get to that same driving form, that deposit form. So there is that. Back to the balance sheet. So there's the balance sheet side. Let's take a look at the profit and loss side by going to reports up top, drop down. We're going to go to company and financial. Going to take a look at the profit and loss. Changing the date range to the dates we are working in, 01/01/17 to, not 17, 01/01/21, January 1st, 2021 to 12/31/21, December 31st, 2021. Looking for the other side of this transaction in terms of the interest. So we should have an other income. Notice not in the income section, because it's going to be other income. It's not part of our normal operations, and the point of that is to say if we were to present this or read this financial statements, we're saying this is the net income of our normal operations, and or loss in this case. And this is the stuff that doesn't normally happen. We don't typically, our business is not the business of investing. Our business is the business of buying and selling guitars, but we had this other income related to it. When we look at our normal operations, you want to take a look at this number. When you want to look at all the normal operations plus the other things that have happened that are outside the norm, then that's going to include the interest income. If we double click on that, we see the interest income here. And if we double click on that, we of course see that deposit slip once again. Closing this out. Last piece of it, if we go back to the balance sheet, you would think would be on the balance sheet showing a 0 for that investment account. However, it's not here. Why isn't it here? Because it is 0 and therefore not showing on the balance sheet. If we want to take a look at it, make sure that that account was impacted, that it is indeed 0 and it was affected by that journal entry. We can go to the lists and go to chart of accounts. And then if we go find that account, it's going to be an other current asset or some type of asset that it was a short-term asset. Yeah, other current type asset. It is at 0. If we double click on it, we'll see the check register. Here's the register. And we see that 12,000 bringing it down. If we look at that deposit, double clicking on the deposit, we'll then get back to that deposit sheet. So that's the recording of investment that has become due. We've received the deposit. Oftentimes we see this on our bank statement where we have this deposit, in this case for $12,250, and we then need to decide, well, how are we going to record that, because one of our investments then must have become due, and we're going to have to record that increase in our checking account and the decrease in the investment account, as well as the related interest or type of earnings that happen, probably interest or dividends.